3, 2, 1, and it is Thursday again. United States of America, United States of America, aggregate bond performance. Now this goes back to 1990, but I'll tell you what it's all about. Aggregate bond yield to maturity in blue and 5-year forward returns in red. Now this is your 5-year bond, and if you look at it and track it back, you can project forward from it to see what the future return on an average bond fund is going to be. Follow the link and read it if you want more details than that. But basically it means that if you follow the standard 60% equity, 40% bond fund weightings, that means over your 5-year coming returns, your 5-year coming returns from your bond side, your 40% side of that fund, you're going to only get 2% out of that over the 5 years. Very low bond returns over the next 5 years, this predicts. Which means that your 60% equity fund needs to return an average of 12% per year to average your expected return of 8% a year, which is what most pension fund returns are meant to be, 8%. With a 60-40 weighting equities bonds, the bonds are going to perform badly at 2%, which means that the equities must perform very well at 12%, averaged out over the next 5 years to get you your 8% return per annum. Got it? Yeah. Obviously it can't predict the future completely right, but this is the best stab that they've made at it. So just to get the other side of that, I had a quick Google and got this for us. United States, the average annual stock market return for the past 25 years has been 10.5%. So even including the boom years, going back in the 90s, you're still not going to get that 12% to balance out the bond badness, so you can get an overall 8%. Or let's say the pension fund managers aren't going to be able to do it. Stock market returns over the last 20 years is 9.4. Returns over the past 10 years has been 4.5, and that's including your dividends. And for the last 5 years, it's been 2.3%. From that, I would say that the people with the bulk of their money in pension funds over the next 5 years are going to do very badly. But of course, we can't know the future very well. But you're going to struggle, aren't you, basically? And your pension fund is going to struggle. Right. Oh, on the interwebs, there is still an awful lot of fuss going on about this miles driven in America and gasoline delivery and sale, obviously. And this one is weekly US product supplied of gasoline versus miles driven. Miles driven is in blue, which hasn't gone down as much as gasoline product supplied, right. And the idea is the gasoline supplied is going down, so we'll soon going to see the blue follow down as well. There doesn't seem to be too much doubt that this is a definite trend, that the US is just not trucking. Now this is gasoline, so this is cars driven as opposed to yesterday's, which was diesel trucks. But you know what I mean, they're not on the road. They're not. The economy can't, the American economy gets out on the road and does things. And if they're not getting out on the road, the economy is not doing something. And the thing is that this will show up in the figures sometime. Probably. There's another chart. There are more if you follow the link. Weekly US supply of gasoline. Now, this goes back to 1990, and you can see the little grey blobs at the over right in the most recent, and they're coming down and down and down. We expect these to be low because these are seasonal, and driving in late January, early February is liable to be low because there's liable to be adverse weather conditions. But there hasn't been so much adverse weather conditions this year, and that latest grey blob has come down an awful long way. And the blue line, which is the 13-week average, to try and smooth it out, will come down again. I mean, it's that is a definite trend. And at the end of this article, which is by Bianco Research, with Jim Bianco, and I've seen him occasionally on the television, and he seems to be a very smart person. Some of these very smart sounding people I don't like the look of, but for some reason I get a good vibe from Jim Bianco. Anyway, he writes, or his team does anyway, we would not suggest that these economic indicators, that's this gasoline and miles driven, indicators trump all others and the economy is actually worsening, but it is disconcerting that these measures of critically economic activity are heading lower in a hurry. Maybe these two measures are sending false signals, but it is possible they are really pointing the way for a faltering economy. For now, we will watch these measures and report on them in the coming weeks to see if they eventually square with other broad-based measures of the economy that say things are getting better. There's a disconnect here. And I'll just throw in, I'm sure it's not that all the other figures are being fudged, that say that it's blah plus. But there is an election coming on. Like, it's interesting to note in France, where there's an election coming on, that France is one of the only major countries in Europe that hasn't slipped into negative GDP. Even Germany has. The entire Eurozone has slipped into negative GDP, but France just happens to be just above the line with an election coming. The closest I'm going to get to conspiracy theory there. Okay. Grigor gives us this chart, which is interesting as well. It's total full-time and part-time employment since the Great Recession thing. At the start of the Great Recession thing, there were 5 full-time jobs for every 1 part-time job, and now it's nearer 4 full-time jobs for every part-time job. I mean, it's not quite 5 and it's not quite 4, but the trend is there. It came down, and it's not really getting back up. So from 5 full-time jobs to every 1 part-time, and now closer to 4 full-time jobs for every 1 part-time job. This is David Leonard, so it's the New York Times. Washington. With little fanfare, China's currency has appreciated significantly in the last year and a half, leading many economists to question whether the exchange rate is still the most important economic issue for the United States to press with China's leaders. The rise of the renminbi, up 12% since June 2010 on an inflation-adjusted basis and 40% since 2005, has helped American companies by effectively reducing the cost of their products in China. In the last 2 years, American exports to China have risen sharply. American exports are doing really quite well. And a lot of people are still behind that information on renminbi appreciation. Moving on to Italy. To cut F-35 fighter orders by 30%. They were going to buy 131 of these F-35s from Lockheed Martin, and now they're only going to buy 90. And I wouldn't be surprised when it comes down to it, it'll be less than that as well. From the Financial Times Europe, Dublin, Ireland, gets the green light on job creation. Now, it's an interesting article, and it's interesting the way it's been titled. And I'll read you the first 2 paragraphs. Dublin has won agreement from its international lenders to use some of the proceeds from selling state assets on job creation projects. That's a weird opening start, isn't it? We're not even finished the sentence. Paving the way for the sale of energy companies, a stake in Aer Lingus, the airline, and even its forests. So it's got permission from its international lenders to sell Ireland's assets and has got permission to spend the proceeds on job creation projects. That's sort of the twisted thing that's going on at the moment. I'll leave the second paragraph. Pause and read if you like. From the United Kingdom, Direct.gov, trying to find a job, you go to this job search site, Direct.gov, and Tesco, the big supermarket, you can go and work there for a wage which is noted as JSA plus expenses. JSA is Job Seekers Allowance, which is the dole. That's what you get paid for not working, and you can get your expenses. Maybe they'll pump your tyres up on your bicycle when you get there or something. And I think the Job Seekers Allowance in the UK at the moment is £67.50 a week, which would be, what, $100 a week, something like that? Plus expenses to work at Tesco's. Finish with this Sky News in the United Kingdom. Iran and Al-Qaeda core leadership under Ayman al-Zawahiri have established an operational relationship amid fears the terror group is planning a spectacular attack against the West. There are concerns such attack, possibly targeting Europe, would be in revenge for the killing of Osama bin Laden by the United States last year. Sky News Intelligence. Oxymoron. Sources have said Iran has been supplying Al-Qaeda with training in the use of advanced explosive, some funding and safe haven, as part of a deal worked out in 2009 which now has led to operational capacity. Are we being softened up for Iran to be roughed up? I think we are. That's it. Bye.